You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Stocks zigzagged on both sides of the 10,000 level through the week as volatility continued to be the watchword in the market. A bit of good news came from the Eurozone in a report that German industrial orders rose a little bit more than expected. U.S. economic news was mainly upbeat, and Fed Chairman Bernanke voiced cautious optimism about our economy here as the Fed's Beige Book noted some slight improvement. Tech, energy, and bank stocks were all in focus through the week, and concerns rose that British Petroleum might have to cut its dividend because of the Gulf oil spill. Against that backdrop now, we turn to our editor-at-large, Steve Reitmeister, for his read on the action this week. Steve, what do you think?
I think you covered it all. But no, zigzag is a good expression for what happened. We pressed to an intraday low about 9,700 and a half on the Dow. That kind of matches what we saw back when it dipped in late January and February and made a low there. And maybe that's why there was some good support there to push the market back up. One of the things that you didn't mention that seemed to provide some support to the market was, there's concerns about Europe and whether their demand will be slowing for goods. And so when there was a report that Chinese exports are still surging, which the European market is certainly a big buyer of those items, when they still saw that Chinese exports are growing, that gave people some faith that Europe is not sliding as much as we thought. And so that's why you see a little bit of a run-up at the end of the week.
So what about the week ahead? What's on your radar for the week ahead?
Yeah, I still see a lot of volatility. I mean, you could say we're in between some important points. On the low side, I was saying that low of 97, 9,800, which kind of matches what we saw in February, that's kind of on the low side. And on the high side right now in this range is the Dow's moving average at about 10,300. And I can see a lot of fighting back and forth. If we make a move above, I could see us rallying quite a bit. We make a move below, I could see it getting real ugly. So, but next week probably still fighting out that turf battle. Yeah.
Okay, interesting. And all of this would seem to beg the question then, what is the best trading style in the current market? For that answer, Kevin Matris, our market technician, provides a little weekend wisdom. Kevin?
It's interesting because there's a lot of different trading styles out there. You have momentum, aggressive growth, value, growth and income, and more. Some are more conservative, some are more aggressive, some trade a lot, some don't. The key, though, in my opinion, is you have to make sure that you are using a proven, profitable trading strategy. In other words, does your strategy generally pick stocks that go up once they've been identified? Or does your strategy generally pick stocks that get buried once they've been identified? This is all good stuff to know. As for which style is the best style, I would say it has to be the style that is right for you. I mean, there's no one style that is better than the other. They're simply different, and that is okay. So it is imperative that you use the style that fits who you are as a trader, or at least who you want to be as a trader. For example, let's say that you're an aggressive trader and you're looking for aggressive growth picks. You're really active. Don't try to fit yourself into a value style or a growth and income style, because you're going to quickly get dissatisfied. You're going to feel like you're missing out. Even if you're doing good, you're going to feel like you're missing out of stuff, right? Because it's kind of slower paced and you're looking for the action. If, on the other hand, let's say you're a value guy, growth and income, something more conservative, don't try to fit yourself into a momentum style strategy, because that won't work either. The reason why that is the case is because if you find yourself picking stocks that are not in alignment with who you want to be as a trader, you're going to find yourself quickly getting rid of that strategy the very moment it hits a rough patch. And even the best strategy in the world won't make you a dime if you don't use it. But the more confident you are in that strategy, the more likely you are to use it. So the best style is the style that is right for you.
I'm still trying to figure out who I am and who I want to be. Kind of hard, but I'll get there eventually. But I hear the word trading, and we're not necessarily talking about timing the market when we talk about trading, are we?
We're not necessarily talking about timing the market. It can be difficult, although I'm in the camp that believes it can be done. But again, regardless of what style you are using, you really want to make sure that historically your strategy has proven to pick winning stocks. If you can see your strategy has done good in both bullish markets, bearish markets, and sideways markets, you have a very good foundation.
Okay, Steve, real quick. You characterize this market as indecisive?
Clearly from the volatility, but if it has a bent right now, I think it's still towards the downside a little bit until people have clarity. How much will the European issues affect our shores and our economy? And hopefully it doesn't get down too far before second quarter earnings start rolling around in July, which could hopefully give a nice boost for the market.
Okay. And we have coming up next for you, Bull and Bear and Screen of the Week. You'll want to stay with us. Here is your Bull and Bear Stock of the Week. Our Bull Stock of the Week is generally one that's rated a strong buy, and our Bear Stock of the Week generally one that's rated a strong sell. Here to fill us in on the specifics of each, our resident research director, Shiraz Mian. Shiraz, the Bull stock that you've chosen for this week is New York Community Bank, NYB, the ticker symbol. What's the Bull story here?
Well, the bull story is that I'm looking for investments that fit in with an outlook which looks for lower risk profile, more domestic business exposure, stable business, and maybe even a dividend. And New York Community Bank completely fits in that profile. It's about a $7 billion market cap local commercial bank in the metro New York area. Has consistently maintained a very disciplined and conservative underwriting standard even through the bull market. And when the downturn came, this company was in fairly good position. It didn't ask for TARP, maintained its dividend through that downturn. It pays about $1 in dividend, which yields about 6%. Has very strong earnings prospects. The balance sheet is in good shape, and this has enabled the company to pick up FDIC-assisted banks. We see a lot of bank failures in the market right now. So it's in a position to acquire those assets at reasonable prices to further bulk up and grow.
So do the community banks interest you as a group, or is this just one that stands out in that group? This
is just one that stands out. Overall, the group still has to grapple with a bunch of issues, which is kind of a hangover from the subprime crisis that we had. I do like the domestic exposure of this group. I'm not really excited about international exposure, particularly to Europe and Asia at this stage. So the domestic focus is good, but investors need to be selective in the group.
All right, your bear stock is Nokia. N-O-K, the ticker symbol. What's the bear story?
Nokia dropped the ball. In a nutshell, on the high end of the handset market, this was the incumbent leader. It still is, owns about 38-39% of the worldwide handset market, but it was completely unprepared for the entry of a nimble and more innovative player like Apple, for example, who came in 3 years ago and wowed the market and consumers with its iPhone. Nokia has no response in that high margin and high-end market. Wow. It is still a leader. It doesn't have a big presence in the U.S., but in Europe and in the emerging markets, it still has a strong presence and most likely will remain a strong presence, but that's at the bottom end of the handset market. Prices and margins remain under pressure in that market. And my sense is that will start showing up in the company's earnings and estimates over the coming days. I wouldn't be surprised if the stock is down 10-15% this time next year.
Do you think they're going to be able to recover what they've lost in a short amount of time?
Unlikely. There are way too many more innovative players in the high-end handset market, and they have a relatively less competitive operating system than what Apple has, what the Google Android has, or even what Research in Motion has.
It's interesting. So we could be watching this one erode here for some time to come.
Absolutely, absolutely.
All right, thanks for the Bull and Bear of the Week. We appreciate it. If you are interested in stock screens, you won't want to go anywhere. Watch this. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Stocks with upgraded broker ratings is what we are screening for this week with resident top stock screener Kevin Matris, who joins me now once again. I don't know whether this comes at an appropriate time or not, given what the market is doing, but
Right.
it seems like, in general, the more of these types of stocks in someone's portfolio, the better. Is that right?
Absolutely. Look, I'm sure we've all had the pleasure of waking up and seeing one of our stocks upgraded by one of the brokers covering it. And usually when that happens, that stock is going to be in for a good day that day, probably several days, if not weeks to follow, especially if there is some meaty reason behind it. Unfortunately, we've probably all had the experience of waking up and seeing one of our stocks downgraded as well. And unfortunately, that stock is probably going to be in for a rough day and probably several days to follow. And while nobody can perfectly guard against which stock is going to be downgraded or accurately predict which stock is going to be upgraded, it's important to understand how the stocks react to these things. So this way, if you're in a stock that's upgraded, you can stay in, or if you're on the fence, you can get in. Also, too, if you're in a stock that gets downgraded, you should seriously consider getting out of it.
Yeah, staying in winners, getting out of losers, obviously more desirable in investing, not always easy to do.
Yeah, that's a good key to success. What's interesting, though, in this tumultuous market is I have been running screens lately to try to find stocks that have recently been upgraded by the brokers. And the reason why I'm doing this is because tests have shown that companies that have recently been upgraded outperform those that haven't been, and they outperform even more so companies that have been downgraded. Now, a lot of people wonder by how much. Well, I did some testing to find out just how much.
Okay.
So I've got 3 screens, and I did this test over a 10-year period. So check this out. In the first screen, I looked at only companies with broker rating upgrades, so there was a positive change in their average broker rating. In the second screen, I looked at companies where there was no change at all. Whatever the rating was, good or bad, there was no change in the rating. And then in the last screen, I looked at only companies that had received broker rating downgrades. So there was a negative change in the average broker rating.
So upgrades beat downgrades?
Yeah, you'd be right on that. Upgrades did beat downgrades, and while the tests didn't reveal anything unexpected, broker rating upgrades did beat the downgrades, the magnitude was a bit of a surprise. So check this out. If you look at the companies with broker rating upgrades, the average annual return over the last 10 years was 10.4%. Looking at the companies where there was no change, the average annual return was 6.1%. But if you look at the companies that had received broker rating downgrades, they actually experienced a loss of minus 0.3%. So the upgrades beat the companies with no change by a factor of almost twice as much, and they beat the downgrades by a significant amount. In fact, that was the difference between making money and losing money.
Okay, big difference. Quickly, some stocks that came through the screen.
Yeah, here's 5 of them. You've got Applied Microcircuits, CAI International, Consolidated Graphics, Dolby Labs, and Gildan Activewear. All of these companies have recently been upgraded by their brokers, and you can screen for this on virtually any screener out there.
And how many stocks total came through?
I think there was about maybe 30 stocks that came through.
Okay. Do you own any?
I do have Dolby.
All right. So you see, screens are not just something reserved for the home improvement store any longer, at least not when you're talking about investing. Roundtable is next. Kevin joins us there as well. Stay with us here on Profit from the Pros. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Time now for our panelists to present the bull and bear case for the stock market this week, as well as their individual top stock picks. Joining us once again, Editor-at-Large Steve Reitmeister. Resident Research Director Shiraz Mian, and Market Technician Kevin Matris, all here at the Roundtable. Shiraz, I'm going to start with you for the bullish scenario because I think you're still decisively a bull, right?
Sure. The underlying theme for my bull case is that the growth outlook for the U.S. economy and the handover of the growth momentum from the fiscal and monetary stimulus-driven measures, as was the case earlier, to the private sector is well underway. Now, the stock market's decline from its April highs to later in May and even up till now is basically an effort on the part of market participants to size up how much of the blowback from Europe and concerns about Asia would affect the U.S. economy. There would be an effect. The U.S. economy will slow down. S&P 500 earnings would be affected, but not to the extent that we should all lose sleep over. My sense is that we are very close to the stage where the market will get a good understanding that maybe we're not growing at 3.5% GDP growth rate, but it's in the range of maybe 2.5% to 3%. Maybe there are some downside risks to corporate earnings, but not significant enough to keep pushing the market down. And that's basically the crux of the bull case.
Okay. Well, now Steve is going to present the bear case for us, and he's not necessarily in the bear camp. We don't know that. But we have to ask
it's just
him
a
that.
growing concern that the investor has to be in. So I'd like to believe that Shiraz is correct, and that's probably most likely where things are at. But you got to say that everything that we were worried about as the market was racing towards a bottom in March 2009, that maybe there's the world governments and all the stimulus and all the debt they piled on, all we did was kind of push that can, kick that can down the road, and yet still all those potential problems exist. And so when we see the problems arising in Europe, and it's just one nation after another that we're hearing about, it's starting to raise up those concerns that we had back in March of 2009. And so whether even you put a 10, 20, 30% likelihood on those things happening, that is why the market is having this pause and like, okay, how much farther can we go if this indeed is where we're at, that all that debt, that asset bubble, all these things are really coming home to ruin the economy. So that is the bear case that one has to be cautious of.
So are you a bear?
I'm not a bear, but I have taken some money off the table and have things like short ETF to try and profit from what I think is still a bearish environment. But I'm hoping that we find bottom here soon, and that it proves out that the economy is rebounding. Just maybe not a V recovery, more of some other kind of letter that's not a V.
Okay. I think Kevin's been spending a lot of time at the Pancake House because he says he's a waffler, right, as far as the market is concerned.
No, I'm long-term bullish, and if I were to simplify the argument, I would say take a look at where the market is now in comparison to the last time we were at these levels. You'd have to go back to 2008, October of 2008, and then you'd have to go, 2009 first, and then you'd have to go all the way back to October of 2008. And the question is, are we now in a better position, economic-wise, corporate profit-wise, recovery-wise, than where we were back then? And I think the answer is unequivocally yes. Now, as far as the short term, I do believe that there still is a possibility that we could see the market pull back to maybe 96 or 95. We finally climbed back above 10,000, but we're still below that 200-day moving average. So as long as we're below there, I believe people need to take kind of a defensive posture. But long term, I believe that if we can just stabilize in this area, possibly move a little bit lower, I think long term we should be able to move much higher because I think the economy is in a much better position now than we ever have been in quite some time.
Quickly, is the S&P the more telling story, the level on the S&P or the level on the Dow?
I would say the S&P is something that professionals probably look at more, but you always hear people quoting the Dow. But in all reality, give or take a couple of points, they usually move in the same direction and in tandem.
Well, Shiraz, I'm going to come to you with that same question quickly because some people out there, I read this morning a story where one guy said, an analyst, Dow 10,000 has zero meaning other than it has more zeros than any other level we're going to see in the foreseeable future. What do you think?
I don't disagree with that statement. I think it's more psychological. I think it plays on sentiment. It makes everybody realize that we have moved to this level, that level. Personally, in my own analytical career, I've never really been a big follower of these technical and sentimental indicators, but they do play a role.
Okay. Now, top stock picks this week. Steve, we're going to start with you. What are you looking at?
I'm looking at Joy Global, which has got a symbol of Joy G. If you believe that over time the world will continue to expand and China and India and other developing nations are going to grow their infrastructure, then you need more raw materials. Joy G creates the mining equipment to get those raw materials out of the ground. So no matter what the market does in the short run, over the long run, it's hard to believe that they will not continue to expand.
Shiraz, what are you looking at?
I'm looking at $3, DLTR is the ticker. It's a $5 billion market cap company with a roughly 9-10% market share of this dollar store retail category. Why I have $3 as my top pick? I'm looking for turbulence and near-term risk. I consider this as a lower risk play on the market right now. It's primarily exposed to the US market, value proposition, growth, even in a down market. It grew last year when everybody else didn't. It's going to grow this year and next. Earnings outlook looks good, and that's primarily the reason for my pick for $3.
Turbulence in the market and the economy or in the retail stocks?
The market, at the end of the day, reflects the underlying economy, retail stocks as well.
Okay, because we got a little bit of a downbeat report on retail sales earlier this morning.
That's right.
Friday morning, before we started talking here. All right, quickly, Kevin, what are you looking at stock-wise?
My pick is Clean Harbors, ticker symbol CLH. They are in the waste removal industry. And the reason why I'm focusing on this one is because management came out and said in mid-May that they are going to be participating in the Gulf oil spill cleanup. And they said that they believe revenues are going to increase by at least 20% because of their involvement.
Okay,
so I think it's a good pick.
Got to leave it there for time. Thank you for joining us. Hope the week ahead is a profitable one for you. With everyone here, I'm Terry Ruffalo. We'll see you next time on Profit from the Pros.